next guest says Australia is, in fact, the most undervalued market in the world. Andrew Pease, the Chief Investment Strategist for Asia-Pac at Russell Investments Group, joins us from Sydney this morning. Andrew, good to have you back on the program. So first off, let me get your reaction to those inflation figures. And it looks to me, judging by the Australian dollar, that rate cut is already priced in.
Yes, they're very simple numbers to analyse this time. Lower than expected. The bank made things easy by telling us after their last meeting that they were just waiting for the CPI to see what would happen before deciding on a rate cut. CPI is coming lower than expected, which makes a May rate cut by the Reserve Bank very likely.
Hi there, Andrew. It's Rishaad in Hong Kong as well with Susan. So, I guess everybody wants to know, is it 25 basis points? Is it going to be 50? And, at the end of the day, what about base effects when it came to this inflation number?
Yeah, I don't think there were too many. It was a genuinely low inflation number. I don't think there were too many base effects. And when you look at the trim, the analytics series the RBA looks at, their so-called trim mean and weighted median, they were both very low. Inflation's pushing towards the bottom in the core numbers, the numbers the RBA focuses on, towards the bottom of that 2 to 3% inflation range. So it was a good number. It means that inflation, instead of stabilising, which is what the banks seemed to be thinking late last year, inflation is still trending lower here. So I think they'll go in 25 basis point moves. 25 basis points in May seems highly likely. After that, it's going to depend on what happens in the employment numbers. The employment numbers here have been all over the place, 1 month strong, 1 month weak. If we get another weak employment number, which will reinforce that trend of very slow employment growth, you'd have to think that the interest rate markets will start looking like they could be correct. The interest rate markets are pricing in 100 basis points of RBA rate cuts over the next 12 months. So 25 in May, possibly 25 in June if we get a weak employment number, and then with the budget coming up and the government likely to pull $40 billion out of the economy, that lines you up for maybe another one later in the year.
Andrew, I want to talk to you about the strength of the Australian dollar. It's weakening today, but you're saying that it should correct even further. And we have Andy Xie, the former Morgan Stanley chief Asia economist, saying that Australia, the currency itself, is in a bubble.
Gigantic.
And demand,
in fact, the whole country is in a gigantic bubble.
Gigantic bubble. Thank you. That's a good emphasis there, Rish. So gigantic bubble. And where do you think the Aussie dollar should be trading?
I don't think the entire country's in a bubble, but I do think the Aussie dollar, and we know currencies overshoot, and the Australian dollar's been in overshoot mode for the last 18 months or so, and it has been the most overvalued of all of the major currencies globally. So, if you look at the average since the currency was floated back in 1983, it's averaged around about 72 cents. But you'd have to say that given commodity prices, although they're coming down, will still remain elevated, you'd probably say 80 to 85 cents is probably more a normal level for the currency, so it's got a lot of room to come down if it does. RBA rate cuts, fiscal tightening, commodity pressure starting to unwind because of China weakness are all adding up to a very strong bearish story for the Australian dollar, I think.
85 cents. That's quite a ways from where we are now. Andrew, we're going to continue our conversation after this. We're talking to Andrew Pease of Russell Investments and get more of his thoughts on global markets after this short break. Stay with us on Asia Edge. Andrew Pease, the Chief Investment Strategist for Asia-Pac of Russell Investments, is with us this morning. Andrew, I just want to get your thoughts also on the earnings season so far. How have you been reading the numbers?
Well, I think that earnings, where we're coming to now is we're at the very mature stage of the earnings cycle so far, and you look at the bottom-up numbers for earnings, and I think the consensus of analysts is looking for around about 13 to 15% EPS growth this year for the S&P 500 companies, and we're seeing that same story across all markets, and that's not going to happen because we know that profit margins are as high as they possibly can be. Profit shares, particularly in the US economy, are back to where they were at the high levels of the 1950s and 1960s. So it all has a bit of air of unsustainability about it so far. So I think what we're seeing is a moderation in profits. They might be coming in a little bit better than some people have expected, but we're not getting the big profits lift. And this is the whole issue with being too bullish about equities right now, is that to be bullish on equities, you need to believe in revaluation because it's not going to be an earnings-driven story. And I think that's pretty much the story that's playing out right now.
Okay, Andrew, I hope you have an umbrella with you. Thank you so much for your time.